Welcome, audience. My name is TK Kerstetter. I am the CEO of Diligence Boardroom Resources, and it's my pleasure to welcome you to the webcast titled The Evolving Boardroom. This webcast is brought to you by PwC, Diligent, the Conference Board, Doug Cha and his corporate governance team there. We want to thank you for being our host today. And again, the Boardroom Resources. Now it is my pleasure to turn the webinar over to Paul DiNicola, who's a principal with PwC's Governance Insight Center, who will introduce our panel and explain today's topic on what's going to be covered. So Paul, it's all yours.
Perhaps the best place to begin is to introduce my panelists today. To my direct left is Michelle Edkins. Michelle is Global Head of Investment Stewardship at BlackRock. To her left, Brandon Reese. Brandon is the Deputy Director of Corporations and Capital Markets for the AFL-CIO. So the investors are on one side here. And over a little bit to the left of Brandon is Aaron Lance. Aaron's Director or Board Member at TrueCar Incorporated. And to her left is Alex Wolf. Alex is a director at Albemarle Corporation and also a director at Versa Materials. So thank you, everyone, for joining today. And so we are going to spend the next 45 minutes or so talking about and getting your responses and reactions to a survey that PwC's Governance Insight Center does every year. We've been doing it for over a decade, our annual Corporate Director Survey. It surveyed this year close to 750 public company directors responded to the survey. And about 3/4 of those were from companies with over $1 billion in annual revenue, so a good sample set. The survey was conducted over the summer months, and we just published the results a couple weeks ago. Interestingly, the distribution from a gender perspective was probably 81% men, 19% women, which is sort of in line with gender diversity rates at public companies generally. So today's we're going to focus on a few different areas. There's lots to cover in the survey, but we decided we were going to focus a little bit on board performance. Then we'll move to a discussion of board composition, and then ultimately a discussion of social issues and their impact on strategy. And finally, we'll end with a look at ESG and sustainability issues. So perhaps the place to begin, I'll start with a controversial place to begin, and that is a question we've asked for a number of years. And again, it's a controversial question. We ask, do you think someone on your board should be replaced? So it's a relatively straightforward question. However, we did get a pretty high response again this year to it. 45% of directors think someone on their board should be replaced. And of that, 21% think 2 or more of their directors should be replaced. So again, very, very high numbers here. But if you take a look at this chart here, you'll see we've asked the question since 2012, and we've seen the number tick up. It peaked last year at 46% and is more or less the same this year at 45%. So why don't I start with, perhaps I can start with you, Michelle. Just your take on this. Why do you think it is that the number has come up to such a peak?
I think it's a really interesting reflection of this delicate balance between enabling a free and frank conversation in the boardroom, but also achieving collegiality, and both of them are part of an effective board. And my sense of the feedback in the survey is some people feel that it's out of balance in their board because certain people's feedback comes from the point that they think directors were overstepping their oversight role and their counseling role with management, and others thought they weren't standing up to management enough. And I think this really points to the importance of the role of the lead independent director and the chair of the nominating and governance committee to make sure that the culture in the boardroom is commonly shared and understood, so people know what behaviors are expected to make the board as effective as possible.
Brandon, what do you think is driving the number up? Is it that the bar has been raised for director expectations, or is it that directors are less inclined to want to ask underperforming directors to not stand for re-election? What's your take on that?
Well, it's always hard to ask someone to step down from a board, and that's just reality of personal dynamics within the boardroom. I think the increase that we see from 35% to 46 and 45% reflects boards doing a better job at self-assessment of the director's qualifications and experiences that they're bringing to the board, as well as their contributions to the boardroom conversation. I also think that it's a reaction to the low turnover that we see on corporate boards, so that directors that may want to, that may have outserved their purpose are not being refreshed at an adequate pace. So in the S&P 500 this year, only 8% of director nominees were new candidates for the board. And at that rate, it would take well over 10, upwards of 15 years for an entire board of 12 directors to refresh themselves. Yeah. So I think that's a two-part answer to your question.
Sure. And so hearing an investor view, I'd love to hear what the directors think about this. Is it your experience? Does it strike you as high? And what do you think is driving it? Maybe Erin?
I agree that a lot of it's driven by rising expectations of directors, and combined with this increased focus on director self-assessment, there's been a lot more visibility, and I think boards are taking that more seriously and looking around and internalizing the data that's coming back. And I think we're seeing particularly board leadership have more of those tricky conversations, but we're not still driving to the outcomes in terms of more rapid refreshment that I think some of the board members are eager to see as a result of that.
I have to say, I still am surprised by these numbers. If you think of any organization, imagine a management team in your company, and 1/5 believe that 2 of the management team should be replaced, or the 45% that someone high up in management should be replaced. That's not very good, not very encouraging. In disaggregating the question, though, I think there are a lot of elements that one needs to take into account. And they're not necessarily all related to underperformance. We heard, for example, maybe the culture is not right, maybe someone doesn't have the right tone in terms of how they're contributing or what types of questions they're asking. And for those, I think moving right away to replacement may not be the best answer. You may have high value, high performing board members who need a little bit of counseling.
Yeah, sure. Sure. So it sounds like some surprise, some potential explanations for why it's the case. So then, when it comes to engaging with companies around board performance, what are those conversations like over the last year for you?
Well, I think, like Brandon, part of our conversation is always about how the board evaluates itself and whether there's a formal process or an informal process and the outcomes from that process. But we also like to just have a more general conversation about how the board works, how they set the culture in the boardroom. And I think one of the more interesting questions from our perspective is, how does the CEO use the board? Because if you want to be a hands-on director and your CEO is very hands-off with the board, that might be a frustrating situation. And we want to get a sense of what purpose the board is serving at that particular company, and whether people's views are aligned about what their purpose is.
Yeah. And Brendan, how are you engaging on issues of board composition and board performance?
Well, I think there's increased investor focus on the role of the nominating committee in selecting director candidates, both the qualifications, the diversity of the candidates that are being put forward, and also we've been taking a closer look at board tenure. Our concern is that long tenure can breed complacency, and that if we don't have adequate board refreshment, we will not have boards who are able to exercise their fiduciary obligations at the highest level. So,
Have you defined what excessive board tenure is?
well, we don't have a hard and fast rule, but we are studying it for examining our own voting policies. You know, I think any board where the median age is over 10 years is certainly a very mature board that might benefit from fresh perspectives on it.
Yeah. Okay. Well, one of the other areas, sort of related areas that we looked at in the survey is board composition and diversity. You know, we got some interesting results in this area. So it was clear from the responses of directors that the vast majority thought that board diversity, broadly defined, brings unique perspectives to the boardroom. It enhances board performance. It improves the relationship that the company and the board have with institutional investors. So all positive impacts. At the same time, there was some cynicism expressed, particularly around what is driving the push for more board diversity. So more than half of board members said they believe that board diversity efforts are being driven by political correctness. Almost half believe that shareholders, you folks, are too preoccupied with the issue of diversity. So maybe I'll start with the shareholders, and I want to get the director view too. But maybe Michelle, what's your reaction to particularly the maybe this is negative, but the cynicism being expressed by a fair number of directors?
Well, we've engaged on board diversity and board composition and quality for many, many years. It's our key area of focus, this issue of board quality, because shareholders depend on boards to protect their interests in conversations we're never going to be part of. And we see diversity as a component of that conversation around board quality. And I think the cynicism is almost a little contradictory to the rest of the results on the other questions. And I also think there's another part of the survey that sort of shines a little bit of light on this, in that women directors, when their responses were separated out from the men directors, actually prioritize different issues quite differently to the men. And I think that in itself demonstrates the value of diversity in the boardroom. You know, our view on diversity is beyond just gender, but gender is the most visible form of diversity, and it's the place to start a conversation because everyone has a woman in their life. Not everybody knows people who have grown up quite differently to them. And so I think it can be a place to start a conversation around how do you broaden your professional network, how do you seek candidates in new places, and how do you as a board commit to broadening that director pool by bringing in first-time directors, whether they're men or women.
Brendan, you surprised by the cynicism?
Well, no, and I think Michelle really nailed the point. The survey shows that only 20% of female directors agreed with that statement, whereas 58% of male directors agreed with it. So there was a strong gender breakdown, and I suspect that you would find the same for directors of color as well. Yeah. You know, we have three expectations for boards. One, we would like boards to have directors self-identify their gender and racial and ethnic backgrounds in a matrix, so that we as investors can get a sense of the diversity of the board without resorting to having to stare at black and white photos in the proxy statement, which is somewhat aggravating and nonsensical. I mean, even you know, every American in the census has to answer that question. It seems that boards could do so as well. Secondly, for nominating committees, we expect that they adopt the Rooney Rule from the NFL, which is that when considering a pool of director nominee candidates, that they must include candidates that are both gender and racially diverse before selecting the final nominee. And then thirdly, we expect that boards, and this again goes back to a point Michelle was making, will use a wider lens to identify qualified board candidates. Too often and for too long, the unwritten rule for board service is a current or former CEO, which is the least diverse pool imaginable. We want boards to be not just looking at current and former CEOs, but at the CEOs of tomorrow, which include women and people of color for selecting their nominees.
Great. Well, Aaron, can you talk a little bit about, from a board point of view, what has your board done to try to think about diversity more broadly and to proactively recruit diverse directors?
We are early in the days of thinking about board diversity. I'm the only woman on my current board, and was not the only woman on my previous board, but certainly, let's say, an outlier compared to the rest of the board. So my onboarding was a big step forward for both of these boards in terms of broadening generational diversity, gender diversity, different industry backgrounds. I work at Zillow Group. I'm focused on consumer technology. So bringing those insights into the boardroom was something that was very new to the traditional banking institution, and even at TrueCar, which is a technology firm, is largely filled with automotive industry folks. So one step at a time. Some of the practical things that we've done very recently, in some cases, is having myself join the Nominating and Governance Committee. We recently onboarded a racially diverse director, and so both of us are on the Nom Gov committee for the express purpose of recruiting from our own networks, because the board wants to source those candidates but haven't in the past. So that's one piece, is kind of encouraging us to serve on those committees so we can take on that responsibility of bringing our networks to the table. And I think the second thing that I've seen be effective is having boards be opportunistic around candidates that they find. So in the case of my prior board, there wasn't an open seat, there wasn't an active search happening, but when the stars aligned such that I connected with the board, they were opportunistic and opened a board seat with the expectation that they would reduce the size when somebody rolled off. So a couple of practical ways that they were able to slowly broaden the diversity of the board.
Yeah, I've seen that pretty frequently in terms of increasing the size of the board for a short period.
Yep.
to not have to wait to bring on newer directors. Yep. And Alex, diversity, and how does Albemarle look at it?
Well, I just want to comment very quickly.
Yep.
Cynicism
Oh,
component,
sure.
and that one didn't surprise me as
That
much.
did it.
as
Okay.
this one, only because I think most organizations, particularly boards, where you have a lot of high functioning, dynamic individuals, personas, probably resent the idea that someone's telling them what to do, even if the ideas are good.
Yeah.
But I'm pleased to say that everything I've heard is exactly how we view this. Diversity is a core value. We expect it of our company, we expect it of our hiring practices and our promotion practices, and as a board, we need to live it as well. One other element that we do when we have searches for new board members, we insist with the search consultant that the slate be diverse. Well, we won't look at it if it's not. And I think generally in the two boards I'm on, two public boards that I'm on, it's very clear that the nature of the conversation has changed. It's richer as a result of being a more diverse board. And so the points that I heard both from Michelle and Brandon are exactly the sorts of things I think a board should be doing.
So it's impacting the top of the chart here, bringing unique perspectives to the boardroom, enhancing board performance, et cetera. Okay. Well, I want to get to. I think you had made, Brandon, you had made the comment about tenure. And if you look at, one of the other areas we asked about was what is driving board refreshment? Okay, and I guess there are different ways to look at this. You can put in a sort of rules-based approach to looking at it, right? You can put in a term limit for board members. You can put in a mandatory retirement age that would be a policy-driven way to push refreshment. There's also the annual assessment that boards are doing in terms of evaluating their own performance and having a much more qualitative, ongoing way of looking at this. So in our survey, we found, again, somewhat of a contradiction in what directors told us between what they say works and what they believe their boards would be willing to do. So, for instance, when it comes to retirement, nearly 3/4 said that a mandatory retirement policy is an effective way to prompt board refreshment. But more than half of those said their board would not adopt a mandatory retirement age of 72 or younger. Okay. Same thing on term limits. 2/3 say term limits are effective in prompting board turnover, but 3/4 say their board would not adopt a term limit of 12 years or less. So maybe I can start with you, Brendan. You know, you're looking a lot at tenure at the AFL-CIO. How would you, you know, guess that this plays out in terms of why directors think that something works well, but their boards, they don't think the boards would adopt it?
Well, I'm not sure if there's satisfaction either amongst boards or amongst investors about mandatory retirement age or tenure policies. My organization, we don't favor a strict rules-based approach to it. However, the concern is that long tenureship can compromise objectivity, that it breeds familiarity. That, in my mind, suggests that long tenure directors should perhaps not be considered to be independent, that they're more like an affiliated or inside director. They still have an important role on that board, but there are caps of how many directors can fill that, right? So the stock exchanges require that half of all directors be independent, and so if you take them out of that classification, it requires an annual assessment as to whether we really still want this director on our board. We believe if Warren Buffett's on your board, he's adding value, and he's been there for a long time, more power to him. But that it's something that we can address. And the other thing I want to point out is that I think it's also incumbent upon investors to take director tenure more seriously. Less than 1% of directors fail to receive a majority vote. It was like 50 directors in 2017. That's a tiny fraction. And to the extent that boards are deferring to the fact, well, the shareholders are re-electing these people year after year, I think that's a concern. We at the AFL-CIO, our pension plans traditionally would vote against 20% of director nominees for a variety of reasons. We recently adopted a policy that we would vote against nominating corporate governance committees that did not have any women directors on their boards. And our withhold vote shot up to 33% this year as a result. And so I think it's part of it is the responsibility of investors to think about taking the director election even more seriously, being more willing to vote against directors, and that's where change will come from.
Yeah. Absolutely. Michelle, does BlackRock have a view on sort of tenure limiting mechanisms like mandatory retirement or term limits, or how are you looking at tenure?
Yeah, I mean, similarly to AFL-CIO, we're looking at the tenure of the directors across the board, and if there's a very heavy weighting to very long tenure, we have to ask, why is that appropriate? But tenure also is often aligned with the company's strategy, and so in oil and gas sector, I would expect it to be a little more normal to have longer serving directors given the nature of that CapEx cycle, for instance. And so I think it's for the company to provide the context around why they think their length of director service for their directors is about right. One of the things that we discuss with companies is whether they're willing to introduce an indicative term limit, so not a hard and fast rule, but where they appoint new directors, both for the sake of the director not feeling they're making a lifelong commitment and for the sake of renewal in the boardroom. You say, we would normally expect directors on our boards to serve a decade or 12 years or 15 years, whatever seems most appropriate for that company. And then you've put a sort of peg in the board, and then it's a more natural conversation. I think one of the most important tools, seeing as people seem uninclined to bring in hard and fast rules, is use the board evaluation process, because it depersonalizes at least a bit the conversation on whether someone is still the best fit for a particular boardroom given their skills and the direction the company is taking.
Alex, how do you have conversations about board refreshment at your company? Is it something that and how does it happen both at the nominating and governance committee and the full board?
We have a guideline that's 72 years old.
So you have a mandatory retirement
rule, but I don't think it's ever been waived, and that has led to significant refreshment.
Is that because it compels you to do more strategic board succession?
Yes, and the directors themselves also see a time horizon as well. But I have to say that we rotated already 3 out, 3 more will be rotating out in the next couple of years. They're all high performers. They're all high quality. They all bring excellent insights and ask superb questions, and the companies benefit from them, which translates only into we have to make sure that whoever's succeeding them is going to be able to fill those shoes.
Yeah.
We tend, I tend as an individual not to like the hard and fast rules, but another metric to look at, and I think someone mentioned it before, is the average board tenure. If you have a board tenure that on average is 10 years, it probably suggests that some people may have been there a bit too long. In one of our boards, the board tenure is about 4 years, and the other average is about 3 years, and that's a new company. So if your average is 5 years or less, it suggests there's active board refreshment going on.
Yeah. And Aaron, you joined your board relatively recently, a couple years ago, and so is that part of? Can you talk a little bit about the philosophy around board refreshment that may have led to you joining the board and how you're currently thinking about it at TrueCar?
My joining the board at TrueCar wasn't a outcome related to kind of intentional board refreshment. I think it was more a matter of bringing tech insight and diversity to the board. So that was what prompted it. It was also a CEO change and transition from a VC-backed pre-IPO company to a now public company. So there was other reasons to prompt refreshment. With respect to the blunt instrument that is term limits, I'm intrigued by some of the kind of more holistic policies we've seen come out. Microsoft this year announced, kind of like you were alluding to, Michelle, a target policy, right? So set an expectation around what they're aiming for, although not a hard and fast limit, for blended average tenure for the entire board, which again is also adjusted for the type of company that you're in. So in a tech company, perhaps 10 years is kind of the outer edge of the refreshment period, but in oil and gas, I think it's a very good point that you might have a longer point of view. With respect to younger directors, I get asked this question a lot. Are you anticipating staying on this board for 40 years? And the answer for, I don't want to speak for all younger directors, is that we can't imagine working anywhere for more than 10 years, particularly for board service. But I think there's been a shift in the way people are thinking about their contributions, and it used to be that the kind of target path was find a company and stay there your whole life, and I think most kind of younger generation folks, that's not the way we think about things. There's a kind of portfolio of experiences that you're trying to assemble, and I think younger directors are approaching their board service as well, so you don't need a term limit to force us to look for the next one.
No. So I'm going to shift a little bit, and I think I want to come back particularly to you, Michelle, on this issue. We asked in our survey this year, and it was a follow-up question from last year, around the impact that social issues should have on strategy. So where should social issues fall in strategy discussion? Should they be part of strategy formation? And while it's still a minority of directors who respond this way, we did see significant increases year over year around those, I think, areas like healthcare availability, resource scarcity, human rights, income inequality, broader social issues should be playing a part in strategy formation. So there was a letter for BlackRock's CEO, Larry Fink, this year on the role, what it is that the priorities were for BlackRock, and it got a lot of attention in terms of the letter mentioning social purpose. And so be interested in your thoughts on that and our findings on social issues becoming more part of strategy.
the reason that we discussed social purpose in our CEO letter this year was this was something we've heard across so many conversations with senior leadership of corporations. And it is this recognition that companies depend on multiple constituencies to be successful. It isn't just shareholder capital that makes a company successful. It is the people, it is the community, and so on. And each of these issues in the survey are likely to affect a company's employees as much as their sort of production processes. Resource scarcity may be a little more on the production side. But the point is that it's a recognition that unless CEOs and corporate leadership are thinking about the business model holistically, they're missing competitive opportunity or perhaps risks.
So in engagements, are you seeing change? And that when you're engaging with companies and boards, are they focused on these issues in a way that maybe they weren't a year or two ago?
Well, we shape or frame nearly all of our engagements around governance. So our interest is in how does the board ensure that management are taking the right approach to these kinds of issues, where they're material to how the business operates. And so that's a conversation around long-term strategy. It is around how the company sets its purpose, how the board assures itself that the culture supports the long-term strategy and that these things are aligned, because when they're in conflict, nobody really knows what's expected of them. And so they're definitely a slightly different conversation now, but it's not just in our engagements. You're seeing it with CEOs taking positions publicly that I think historically they might not have, because they recognize that their constituents, and particularly their employees, expect them to have a view on key societal issues.
Yeah. And Aaron, if I could ask you from a director's point of view, how are these issues making their way into your board's discussions or strategy more broadly?
They're mostly impacting us on the employee retention, engagement side. So particularly affordability, healthcare, and housing. Those are issues that are very impactful to our employees and therefore impactful to our ability to be successful, both at Zillow and at TrueCar. I would like to say that we as a board have focused more on kind of how social issues are impacting our core strategy. I think we're not there yet, beyond the employee impacts on social issues. With respect to financial services, the extent to which social issues impact the macroeconomic environment, that was certainly something we were paying close attention to, and that would impact our investment strategy. But I think there's opportunity for most companies to think more closely about these with respect to kind of influencing the overall company strategy.
Yep. Well, Brenda, being a labor pension fund, I'm sure many of these issues are near and dear to your heart. So how is AFL-CIO looking at issues like social issues? Yeah, social.
Well, it's our view that over the long term, the interests of shareholders and stakeholders of the company converge. Right? We all want a sustainable, productive company that creates value for everyone involved. The issue of corporate responsibility is not new to America. We're meeting today at the conference board, which was formed in response to the Triangle Shirtwaist Factory fire in 1916. So if directors are uncomfortable discussing social issues in 2018, yeah. They just need to read their history books. But when we engage with companies, we engage on governance issues as well as social issues that speak to our core competency. And as a labor organization, that obviously includes human capital management as well as worker rights issues.
Yeah. Okay. Well, I guess the final issue that we did want to talk a little bit about today is environmental, and particularly environmental risk, but environmental and sustainability issues. And what we found in the survey is that directors somewhat deprioritized this area. And so more than half said that from a board composition point of view, it wasn't necessarily important to have environmental or sustainability expertise on the board, right? So that's on the board composition side. When it comes to environmental issues in particular, 39% said they didn't think that climate change should impact their company strategy at all. And nearly a third haven't taken any action to respond to environmental issues. And again, this sort of comes back to some of the cynicism that nearly a third say shareholders are focusing too much on ESG related issues. So why don't I start with the director view here? So maybe Alex, I'll come to you. Can you talk about how your boards are integrating a broader, more holistic view of ESG issues, and how you give it priority?
Well, Albemarle and Versum both are especially chemical companies, so there's, I think, a greater sensitivity to the potential risks of getting this wrong. I think in both instances, looking at environmental concerns, sustainability, are part of our core model and core culture. It's hard for us to imagine not weighing those elements when we're making a capital investment somewhere, or opening a plant somewhere, without factoring in how we can sustain our presence there long term. And as a company, we engage with the local community. We have a committee in each plant that includes local community. In our operations overseas, we consult and work closely with indigenous communities in remote areas. Sustainability, where water is scarce or energy is scarce. Again, it's just very sound business to have the most environmentally sound and viable policies in place. Otherwise, you're not going to be successful as a business. We have a foundation that also looks at contributing funds to projects that can move this along. And most importantly, we compensate based on this. This is a metric which we include in our long-term compensation.
And how is it dealt with from a board composition point of view? Do you have someone on your board who has expertise in this area? Do you use outside advisors? Do you think that's something that is worthwhile doing? How do you make sure that you have the right composition in order to effectively, as a board, oversee these areas? Because they're so important to your business.
Right. I can't say we have board expertise per se, but we have people who've operated plants before, CEOs from industries and companies where these issues have been front and center. We do have expertise in the company. And so the people we hire to monitor these programs and to come up with suggestions, who brief the board directly, do have sector expertise in environmental issues.
Okay. Michelle, does this worry you that directors seem to be deprioritizing these issues a fair amount?
I agree with what Alex said, in the sense that I think sometimes this is definitional. Does the environment generally matter to us? Maybe not. Do you have inputs in your business process that have an environmental component to them? And you mentioned water, but also there's waste production and so on and so on. And if you do, as a board, you need to understand those things. And I think most good boards do understand that. But I think using language that is not business operational language can make it sound like it's something other than what the board does. I would even agree, and it might be surprising to you, that with the directors who say we don't need this single level of expertise in our boardroom. Some companies may have a very specific risk to a very specific factor that means they want that specialist expertise. But broadly speaking, I think it's better that the board depends heavily on management and potentially gets independent external counsel, but that the whole board has expertise. Because if it's a key value driver or risk to the business, the whole board needs to understand it. You can't rely on one person picking up everything.
Mm-hmm. Brandon, same question. Does this concern you?
Well, it's hard for me to imagine any company that will not be touched in some way because of climate change, be it even from a business continuity after a natural disaster, a hurricane in the east or a wildfire in the west. It seems that this is something that boards need to be addressing. I think it's also something that investors are also asking for more information about as well. That if it's not being measured and it's not being managed, both at the board level and also being priced into the market, right? So that's why we signed on to a petition to the SEC last month asking for enhanced disclosure of ESG issues, because we think these are important contributors to shareholder value, either from a risk management standpoint or value creation standpoint. And so we think that companies can and should be providing enhanced disclosure to their investors, or the owners of the company, about what they're doing to manage environmental risks.
Do you think that there is sufficient information out there right now for you as an investor to make informed decisions around ESG issues?
No, that's why we're petitioning the SEC. Yeah. But however, let me say that that when companies have started providing this disclosure on a voluntary basis in response to shareholder engagement, through responding to shareholder resolutions, to informal dialogues with shareholders, companies are starting to provide this. But because we don't have uniform presentation of the information, it's very difficult for investors to digest it when you're relying on a corporate social responsibility report as opposed to a uniform SEC disclosure. And that's why we petitioned the SEC to provide that enhanced disclosure that would be both uniform and consistent across all market participants, not just the good actors who have seen the light and want to voluntarily provide this information to their investors.
Yeah.
Can I just
Sure.
add on this point? If anything, there's probably too much data, but not enough information, and certainly not enough investment relevant information. It's tying it back to why the reporting relates to the business and how it generates value. And at the moment, there seems to be a confusion with just pushing everything that you've got into the public domain to interpreting it and shaping it for the investor audience as one of your critical audiences for information you produce.
So, Michelle, where's engagement going in 2019 around ESG issues for BlackRock?
Well, again, I don't really like the ESG phrase because I think governance comes first, and when you get the right people in the boardroom, kind of what the survey says, then a lot of the rest of the environmental and social impacts the company has are well managed by management and overseen by the board. And so, our focus continues to be on governance and on disclosure so that we can understand how well a company is governed. But I do think some of the issues you've identified here, environmental externalities of a company, more and more companies need to anticipate having their current externalities become internalized. And I think that can change or has the potential to change business models. I'm sorry if that sounds a bit economic-y, but I'm an economist by training. I agree totally. Climate change is another phrase that people interpret quite differently. But if you're talking about extreme weather events, I don't think you can open a newspaper in the US, let alone elsewhere today, without seeing about something happening in this country. So I think it's just perhaps coming back a little bit off the language and focusing more on what's material to how a company generates value.
Aaron, I'm going to give you the last word this afternoon. Can you talk a little bit about how the TrueCar board looks at environmental and sustainability issues?
I think, like I was alluding to before, this is not front and center for us. I think there's work for us to do, but as a tech company, we're focused mostly on building a website. And so there's less kind of tangible environmental impacts that we're dealing with and thinking through on a day-to-day basis. We're really more focused on the employee impacting components, which is where the cost of living plays into a lot of employee issues, whether it's from recruiting and retention all the way to what is the compensation strategy that we have for the company.
Okay, I really appreciate everyone joining this afternoon. Great to hear what both the investor side and the director side, how you react respectfully to our survey results. So thank you.
Paul, I want to thank you for pulling out these tidbits from your annual study. It's always interesting, and we appreciate that. Panel, we want to thank you again for taking the time to come and giving your views. We want to thank PwC, Diligent, the conference board, our host today, and Diligent's Boardroom Resources for their efforts. And that will conclude the live portion of the webinar. We want to thank our audience for joining in on us. And with that, have a good day, and thank you for joining.